Navigating the global chessboard, the role of geopolitical risk in shaping investment trends. Introduction. In the interconnected web of global finance, the role of geopolitical risk emerges as a formidable force, capable of reshaping investment landscapes and steering the fortunes of investors worldwide. Geopolitical risk, influenced by political, economic, and social factors on the international stage, introduces a layer of complexity that demands astute analysis and strategic foresight. Understanding the intricate dance between geopolitical events and investment trends is essential for investors seeking to navigate the ever-evolving dynamics of the global market. Geopolitical risk unveiled. Geopolitical risk encompasses a spectrum of uncertainties arising from geopolitical events, including political instability, trade tensions, military conflicts, and diplomatic upheavals. These events, often emanating from the interactions between nation-states, have a profound impact on the economic and financial landscape. Investors must grapple with the unpredictability inherent in geopolitical risk. Recognizing its potential to trigger market volatility, reshape trade dynamics, and alter the risk-return profiles of various assets. Trade wars and economic fallout. One of the most palpable manifestations of geopolitical risk in recent years has been the specter of trade wars. Trade tensions between major economic powers, such as the United States and China, have sent shockwaves through global markets, creating a ripple effect that extends far beyond the realms of politics and commerce. Tariffs, trade barriers, and retaliatory measures disrupt established supply chains, affecting corporate profitability and altering the risk calculus for investors. Consider the scenario of escalating trade tensions between two economic giants. As tariff announcements reverberate through financial markets, investors may witness heightened volatility, with industries directly impacted by the trade dispute experiencing sharp corrections. Conversely, assets perceived as safe havens, like government bonds or gold, may attract increased demand as investors seek refuge from the storm of uncertainty. Political instability and market jitters. Geopolitical risk is often amplified in regions characterized by political instability, where sudden regime changes, civil unrest, or geopolitical tensions can have profound economic implications. Investors navigating such environments must contend with elevated uncertainty, as political developments can trigger rapid market fluctuations. For example, consider a country experiencing political upheaval due to contested elections. The uncertainty surrounding the political outcome may lead to a sell-off in local equities and currency depreciation. Investors, in response, may reallocate their portfolios to mitigate risk, favoring assets in more stable regions until the geopolitical fog begins to lift. Energy markets and geopolitical hotspots. Geopolitical risk exerts a pronounced influence on energy markets, with oil and gas prices often sensitive to geopolitical tensions in key producing regions. Conflicts in the Middle East, for instance, have historically sent shockwaves through energy markets, impacting not only the cost of fuel but also the profitability of industries dependent on energy inputs. In a hypothetical scenario where geopolitical tensions escalate in an oil-producing region, investors may witness a surge in oil prices due to concerns over supply disruptions. This spike can have cascading effects on industries ranging from transportation to manufacturing, prompting investors to reassess their portfolios in light of the evolving geopolitical landscape. Global supply chains and investment strategies. Geopolitical risk has the potential to reshape global supply chains, impacting industries reliant on efficient and cost-effective production processes. Events such as trade disputes or geopolitical tensions can disrupt established supply networks, leading companies to reassess their sourcing strategies and production locations. Imagine a multinational corporation with an extensive supply chain spanning multiple countries. If geopolitical events disrupt the flow of goods or increase trade barriers, the company may face challenges in maintaining operational efficiency. Investors monitoring such developments must factor in the potential impact on corporate earnings, supply chain resilience, and the broader economic implications for the affected regions. Currency markets and exchange rate volatility. Geopolitical risk has a direct and immediate impact on currency markets, with exchange rates reflecting the relative strengths and vulnerabilities of nations amid geopolitical turbulence. Investors engaged in international markets must be attuned to currency fluctuations, as these movements can enhance or erode investment returns. For instance, a geopolitical crisis in a major economic hub may lead to a flight to safety, causing the currency of that nation to appreciate. In contrast, currencies in regions directly affected by the geopolitical event may experience depreciation. Investors, cognizant of these dynamics, may adjust their currency exposures to capitalize on potential gains or shield their portfolios from adverse exchange rate movements. Diplomatic developments and global alliances. Geopolitical risk is also influenced by diplomatic developments and the evolution of global alliances. Shifts in diplomatic relations or the formation of new geopolitical blocs can have profound implications for trade agreements, economic cooperation, and investment climates. Consider the scenario of a geopolitical realignment where nations forge new alliances or dissolve existing partnerships. Investors assessing the potential impact on international trade, economic cooperation, and market access must adjust their investment strategies accordingly. Industries reliant on specific geopolitical alliances may experience shifts in competitiveness and market dynamics, prompting investors to reassess risk exposures. Conclusion. In the complex tapestry of global investments, geopolitical risk stands as a formidable force, shaping trends, influencing market sentiment, and introducing a layer of uncertainty that demands a strategic and vigilant approach. Investors, armed with an understanding of the multifaceted dynamics at play, can navigate the global chessboard with prudence and foresight. As geopolitical events unfold, the wise investor remains attuned to the nuanced interplay between political developments and market forces, ensuring a resilient and informed approach to global investment trends.